we talked at last. We talked about different. Yes, dig down. Different types of investments. Now, company A investing on company B. Now, they could invest either 0 to 20%, or they could invest between 20% to 50%. You brought the breakfast of 50 to 100%. We discussed about these three different possibilities of investment, and this type of investment we not named it as ordinary investment, and this type of investment we named it as investment in associates, and this type of investment we named it as investment in subsidiaries. And related accounting standards are IFRS 7, IFRS 9, IAS 32 and 39. So these are the related accounting standards that is pertaining to ordinary investments. When we will have separate session to talk about what are the accounting provisions implicating this particular type of investments. Second, associates, IAS 28. And third one, subsidiaries, IAS 27, IFRS 3, IFRS 10. These three standards in particular for the discussion of investment in subsidiaries. In addition, there are some other standards as well might be relevant under our discussion. One is IFRS 11. IFRS 11 pertaining to interest in joint ventures, and then IFRS 13 fair value instruments. So our scope of this series of discussion will be particular to this and this. We will not take the first one in this series of discussion. That's what we discussed in the last class. Today we will talk about certain definitions, certain key terms that is repeatedly used in the group accounting. One of the terms, a very important term, is parent. Now, what is parent or who is parent? From a literal language, we all know the meaning of the parent. So the similar scenario will be applicable when come to group accounting. What happens is, you have a company. This company is investing in another company, B, and this A invests and secure interest. At this point of time, I will not prefer different terms. What happens is that the company A putting up some of their funds to company B and secure certain interest. The interest we have talked about here. It could be an ordinary investment, it could be an associate, it could be a subsidiary. In this regard, who is now parent? Parent is the entity A. Entity A becomes the parent where they are securing interest in B. Is that clear?
Yeah.
Yeah. Now we also have someone called subsidiary. Now before I talk about subsidiary, I would rather discuss control. Now what is control? From a literal English language, what do you think control is? How can we define control?
The one who guides.
One who?
The one who guides.
Or the one who guides?
System.
System.
Who operating?
One who operates. Yeah, Mr. Mansoor, what is control?
Control is control.
Control is control. Ah, very good answer. Yes.
Control is
Control. But other control. Yes. Siddhi?
Managing. Controlling.
The control could be taken by many people. Now, from let's forget about accounting. Let's look into our domestic life. The parents, we say that parents has the control of the kids in theory. Okay, in theory. So within inverted commas. So what do you mean by that? What do you expect when you say that the parent has the control over their kids or children? Meaning the direction of the kids' activities are
Controlled by the parents.
done by whom? The parents. So the kids need to carry out their activities, supposed to be, by the parents' direction. Am I right? So the term control means that an entity, if an entity secures power in the financial and operating policy decision making. You have a board of directors, you have board meeting. In the board meeting, there are different decisions are being taken place, so it's been conducted. And when someone who has the say, look, you get out, don't come into this room, or look, you purchase this, look, terminate this contract. This type of power. If someone has that power in leading the financial and operating policy decision making. Now, hiring, firing, board of directors, or conducting or carrying out activities which is in other words meant to have power. For all of this, we say that they have the control. How can I secure the control? The securing control, mathematically one possibility. There is one possibility of securing control from a mathematical point of view when the entity A has investing, or entity A is investing on entity B and acquiring 51% or more of voting rights. You don't need to purchase the shares. You only need to buy the voting rights.
Some shares, they don't have voting rights. They are called non-voting shares. So you have to have voting rights. Voting rights, that's the very important thing.
Now normally what we said, you see here, we said that with above 50 and 100, we named it as subsidiaries. Mathematically, we look into say that the company has 51 or more, and many times people make a mistake. They think that if you do a mathematical calculation, total number of shares 100, someone purchased 60 shares, alas, they have the control. So 60 over 100 into 100 meaning you get 60%. 60% meaning about 51. So we decided, okay, colors, they have the control, which is not correct. Although you may have in numbers or by maths, you may have 60% of the shares, but you may not have the right of voting. Good example, Qatar Petroleum, now QE, previously Qatar Petroleum. Stop funding Qatar Petroleum has signed up many joint ventures. Example, Occidental Petroleum or North Oil Qatar or Total. These companies, what do you think? What do you think? Who will be the major investor? One American company or one Danish company, one European UK company coming to Qatar and signing up a joint venture and commencing a business. Who would be making the investment? You think that the foreign company will be the person who is investing in this particular joint venture. However, all the decision-making rights are with Qatar Petroleum. So here the question is whether you have the voting rights or not. If you can demonstrate that we do have the voting rights regardless of the number of shares that I have, then I have the control. So for example, you may have 40% of the shares. But if you have the right of appointing a director, appointing an auditor, signing up a contract, changing an agreement with someone and so on, then you have the control. Is that clear? So control can be secured by 4 ways. The control can be acquired or secured in 4 different ways. First, by shares, purchasing the shares. That's a literal thinking, literal understanding. We read that, okay, the company has 1 million shares, they purchase 600 or 700,000 shares, colors. We decide that control has been secured. Secondly, regardless of the number of shares, there are other aspects also you need to look into. Number two, by virtue of an agreement, you sign up an agreement with the investee company. You are the investor company, and you have the, now in this diagram if you see, B is the investee, A is the investor. So investor company has an agreement with investee company to say that we have this. So that also means to say that they have the control. And thirdly, if you represent majority of the board members in the board of directors. Now you have 10 members, you represent 7 members there. Although your number of shares only 40%. But you say you representing the board members by 7 out of 10.
Yes.
Then regardless of the number of shares you have, you still have the. And also finally the investor company can also have the control by directing, if they have the power of directing the other, for example, because of the technical knowledge. Now, oil and gas industry knowledge. Company A has super knowledge of that. Company B only has money. Now, company A invests only 30% or 20% or 10% for say. Yet, company A will have control because that particular activity, the company A only know the know-how. This expertise, this know-how only in possession of company A. So therefore, it is also said to have control. So, you want,
Facebook is a good Facebook.
yes, Facebook.
Facebook is a good example. I think Mark Zuckerberg owns less than 30% something, but still he controls. Because you can't remove him, he's the one who operates.
Hmm.
He's the one who knows how everything.
Exactly.
So obviously, even if you have 10%, he will have the control. And to make that agreement, break the agreement, all those things.
Please also understand later when you prepare the financial statement, there is a requirement to prepare something called consolidated financial statement. Now, consolidated financial statement in whose books is the question? Now, let's say it is company B, you have A, 30%, let's assume 30%, and C, let's say they have 55%, and D, they have 30, 85, three different group of shareholders or entities have investing on this. Then we need to decide who has the control. Unless otherwise additional information provided, but you think who has the control now? C. But if they say, although C has 55% shares, the decision making rights are with A, then A has the control. C becomes a dummy person. You know, the president in UK.
India,
President in UK, president in India,
King in Malaysia.
king in Malaysia, kings in house. All the kings at house also sometimes same, no?
But their president are not elected by the people.
Who?
Indian president not elected by the people.
Yes, sir.
Yeah.
That's the devil.
Okay, yeah, that's the devil, yes. But literally we just wanted to elaborate this. That's what the objective is. So you understood what is control now. Okay? So parent, we understood. Control, the power to carry out operating and financing decision making rights. Decision making. This is control. Thirdly, subsidiary. Who is subsidiary now? Now, this is parent. They have control. So, parent has the control over B, then B becomes an entity. When an entity is being controlled by someone else, then that entity becomes subsidiary. Now I will go back to this list here. I also have written associates and ordinary investments. Can I name these entities here? When parent has the control, these entities, I cannot name them as ordinary investment or associate. I have to say only subsidiary. Maybe in your company you can relate and think. You have a parent entity and then you have so many subsidiary entities. See, also we say that you dance according to the tune played by the parent. You cannot change the rhythm of the dance. If you do, then colors. Next day you go home. So, I hope you understood what is now subsidiary also. Now we know what is parent, we know what is control, we know what is subsidiary. And then before that, significant influence. What is significant influence? You don't have the control. In the boardroom, you may have experienced this. There are one or two guys always knock their head and then wait and then say and have the cup of coffee and take the piece of pizza and then at the end sign the document and then they go. You have experience or can you anticipate like this?
This is talking about the board meeting, general board meeting, where a lot of people will attend and they will discuss the audited statement and company direction, future and everything. So if you don't have the control, but these people have more influence. They are.
But they are saying that they don't have the control, but they have some influence over the decision making. See, let's say I'm going to make a decision. I ask your opinion, Mr. Rashad, what you think? You may say X, Y, Z, and I have the right to refuse all X, Y, Z. But I may also have the right to choose one of them. So you can provoke to change my decision in the direction. So this type of entities are known as associate. This type of situation is known as significant influence. These are not control and they will influence in, and how do we say that? They are allowed to participate on forming financial and operating policy decision making process. They are just allowed to participate in that. If you are writing a accounting policy manual, they will also read the document, check the spelling, where the comma to come. This type of minor activities they are allowed to do. That clear. So they are known as significant influence. Now, then we talk about associates. Who are associates? Who has the see? In this situation, who is subsidiary? An entity where someone else being controlled. Then that becomes subsidiary, and this entity we call them parent. In the situation where A, B, they have significant influence, not a control, then this entity is known as parent and this entity is known as an entity where someone has significant influence over this entity. Now for B, can there be someone who has control? Possible or not possible? Can there be another parent, in other words? It's highly possible. Now for example, if they have 30% investment here and when someone has 70% investment, then it's possible. Clear? So now we understood subsidiary, significant influence, associate. Right. So these are certain terms. These terminologies are available. When I share my slides, you will find it. Uncontrolled interest. In the slides you will find it. Otherwise, you can also get it download from the net for the correct definitions. Now we talk about another interesting term. Now you see a situation like this. B. Okay, another possibility. Could a parent have more than one subsidiary? Possible. Could a parent work it? Yes. Obviously possible. Same like this. So you can have 70, 60, 80. More than one subsidiaries might be possible. And now you see here B 80% owned by whom? B's ownership 80% belongs to A. That means there is someone owning 20%. Correct? There someone has the ownership of 20%. This someone, the previous standard, old name was this was the old name, minority interest. But new name, non-controlling. They are some of the shareholders who are still holding the shares of company B, but they have no control over the activities of the company. They just need to keep the money, wait for the dividends, and masala. They are all known as non-controlling interest. So in short, we write them NCI, non-controlling interest. So to continue with this, now let's say I have a company. I have invested 100%. We call it fully owned subsidiary. We name this fully owned subsidiary. Then C has an investment of 70%. Now what do you think the relationship between A and C? What do you mean? Why you say the associates? Now A to B 100%, B to C 70%. What about A to C? 30? Allah, I will kill you. Who said? See, he is very good in bypassing.
Football.
Yes. You are in the what do you call it? Defense, middle. Defense in the football ground. Yeah.
Subsidiary?
No. What is the percentage?
70.
70 also. How you arrive? 100 into 70%, which is 70. Unless otherwise any other information available, A to C relationship also subsidiary. A to B subsidiary, B to C subsidiary, A to C also subsidiary. What happens in this situation? Now what is the situation? Obviously, this is subsidiary. So, A controls B, correct?
Yeah.
And B has 60%. So this is also. Now mathematically, what is the relationship between A to C? Mathematically. Now I have done one calculation here. Same like this. 60 into, which is, come on. Now 60 into 6 into 8, how much? Everyone need to go to the elementary math school. Siddhi, you tell me please. 75, yeah.
18 to 8 is also 64. How come 75?
48.
40? 48. Now a typical problem now. From our mathematical understanding, we said if the number of shares less than 51%, they don't have the control. But you see, but the situation here, now when we say that B is a subsidiary of A has the full control of B. Now then B controlling, who is controlling B now? Habibi, Assalamu alaikum. Mabruk. Oh, good. I said Mabruk. Okay. Brother, I'm in the middle of lecture. Let me. I will call you soon after. After 10:30. I'll call you, inshallah. Who? Okay. So, now, mathematically when you see 48%, when we know that A has the control of B, and that means whatever the activities of B is being controlled by whom? A. So, now, if it eventually then, although 48% is the related amount of percentage, yet C is a subsidiary of A. Please remember, these are some of the examination tips. So, another type of relationship happens like this. A to B, 35%, 80%, sorry, 80%. Here C, let's say 40%, 32, but here another 25. We call it D diagram or D or whatever. If I do it this way, D. So in this case, what is happening now? 32 plus 25. How I got 32? 80 into 40. So this is some basic thing that you need to know. Is that clear? Before I move on to the next topic.
Why not the same percentage between the B and C? Because the main company, the relationship between the A and C, the relationship between A and C is the company of B.
Yeah.
Why not the percentage should be same between B and C?
B
for percentage.
You mean how much percentage?
Yeah, for example, this company number A, the percentage for B is 80.
Yes.
Okay. The relationship between A and C
should also be 80?
should be 40. Same as the relationship between B and C.
You mean to say that A to C should be 40?
Yes, because
No.
the relationship
Mathematically,
between
brother, mathematically not. Why? See, let's put a small mathematical number here.
I know, but I asked it why not, because the relationship between A and C is the company of B. You should be full controlling, or as gives the percentage of control between B and C.
Yeah, see, that's what we are talking about, the substance over form. Literal mathematical calculation, what happens? I have 100 shares here. 80 shares they have taken.
Yes.
Someone else have taken 20. Correct? Now, this 100 go in purchasing 40. So, this 40 shares, if they have 100 and B is buying 40, of this 40, how many shares belong to A is the question. Mathematically, 32. So, this type of calculation, or we have to look for there's something called substance over form. Fine. So, this is now done. Now I will move on to a subtopic called goodwill. talk about consolidated financial statements. Here you see, we talked about control, we talked about significant influence. And when we have control, then the other entity is known as subsidiary. For them, we call them associates. So when there is an entity has subsidiaries, those entities we need to do a consolidated financial statement. What happens is, every entities legally need to produce standalone separate financial statement. Now let's say I have A, B, C and D. 100, 80, 70 for the sake of example. Now how many entities we have here now? No, 4 entities. A, B, C and D. So I have parent and 3 subsidiaries. And as we said, legally we need to produce separate financial statement, standalone separate financial statement for 4 entities. So you will have one financial statement for A, another financial statement for B, another financial statement for C, and one more financial statement for D. Now, this is whose job now? Producing separate, individual, standalone financial statement is the responsibility of the individual management of each of these entities. Now, from a different subject matter, we said that responsibility of preparing and presenting financial statements are with the management. Now here, management of whom A need to produce a financial statement only for A. B should produce their own financial, C and D as well. But now what we understand, that A has secured controls over all of these 3 entities. And then IFRS 10 says you should consolidate all of these financials together and produce consolidate all parent and all subsidiaries. Now when I say consolidate, will there be, see, now for example fixed asset or payable or purchaser, we have ledger accounts, correct? And each ledger account is under each of these entities' books. For the consolidation purposes, please understand that there is no double entries or there is no debit credits. It's a memorandum. Now we will do it in a debit credit style, but those entries are not, why would I name it? They are not formal. They are not formal entries. They are just for the sake of memorandum needs in order to conclude and arrive a financial statement. Now, whose responsibility is to prepare a consolidated financial statement? A. A should produce a consolidated financial statement in addition to their own standalone separate financial statement. So A will have financial statement for A, and A will also have consolidated financial statement for A plus B, C and D. So this according to IFRS 10 and this according to IAS 27. IAS 27 we go and talk about how you produce a separate standalone separate financial statement. Now there are, when you prepare a financial statement, actually it's a very easy approach. Now, okay, before that, now when we say consolidated financial statement, this has major three elements. One, consolidated statement of financial position or consolidated balance sheet. Then consolidated statement of comprehensive income. And then we also have consolidated statement of cash flow. We need to produce a balance sheet, we need to produce an income statement. In other words, I need to have a financial statement which should have all this. Even I should have what? Consolidated statement of changes in equity. And also you will see notes. And I am sure, I assume that Heidel Holding has a consolidated financial statement. And when you see that, the numbers are a combined numbers of all of the subsidiaries. See, from an examination point of view, if you don't understand the bloody consolidation, then still you need to get some marks. What you simply do is that, see, in exam questions, what they're going to do, they're going to present the numbers in a table. They're going to say, we're going to have the statement of financial position, for example. They will have assets, under that you will find categories, then they will have non-current asset and then you will have some categories, then you have equity, and then you have current, non-current liability, and then you have current liability. One golden rule in consolidation, the final answer is the consolidated financial statement. Entity 1, entity 2, entity 3. So this is the parent and this is subsidiary 1 and subsidiary 2. Now there are certain golden principles. One principle, always remember, this is the shortcut I am telling you. The share capital in this consolidated financial statement is only the share capital of the parent. If you don't understand the mechanism, how it works, don't worry about it, don't think about any nonsense, just write down the share capital of the parent, you get 1 marks. That's number one. Number two, what you do is, you do the line by line consolidation. Meaning, let's say I have a motor vehicle, here 100, here 200, here 50. What I do? 200, 300, 350 colors. But problem is, they will keep on giving you additional information which you may have to incorporate in forming the final working. But what I am saying is, the people who are at worst case scenario, at least to get some marks. Right. These two tips very pivotal, important. Now, we need to have some workings. The very first working is, we need to do something called calculation of goodwill. What is goodwill now? Before we calculate, we need to understand the word goodwill.
It's an intangible.
Yeah, it's an intangible, very good. But tell me what is goodwill? think there is something called bad wills there?
You have to trust.
Okay, why? Now, last few days before, I went to my kids' school. Adjacent to the kids' school, there is a McDonald's. We go inside. And in the table, they put a display notice. McDonald's is a 100% Qatari owned company, and all the funds are received by local Qatari owned company only.
Because of the war. Yeah.
Now, people are attracted to go to, for that matter, not only McDonald's, any restaurant. Think about a different restaurant, like Village. The secondary point is the taste. But before then, they decide based on the name.
What about today's meeting?
Correct? The name is what? Is a reputation. Is in other words, is a goodwill. Now, when you hire auditors, you look for Ernst & Young, KPMG, and so on. Why is that? You believe they carry that name, so they are so and so. Actual reality is a different story. Alhamdulillah, extraordinary event, I'm calling back. So, now that is what the goodwill is, reputation. Now we will talk about auditors. Although there may be other auditors who would perform better, but yet they are ready to pay extra premium in hiring. Now I recently heard Qatar Energy recruited Pricewaterhouse to perform a basic bookkeeping activity, and the fee is 1.8 million for 3 months. So they don't have problem of paying 1.8 million to PricewaterhouseCoopers. Whereas someone else will say, okay, we will do it in 400,000, they will give you. The simple difference is the goodwill. So now, goodwill is, there are two ways of defining it. One literal explanation, literal terminology of goodwill is the reputation that the entity carries, which has an additional value. That's a goodwill. Another way of saying it, the difference between the fair value of the purchase consideration and the net assets acquired. You ready to pay 200, but the actual book value of the net asset is only 150. Then what the hell you are paying extra 50? This 50 is the goodwill. So there are two ways of defining it. So goodwill is the that reputational advantage that the essential value. Is that clear? Now we need to know from consolidation point of view how to calculate the goodwill. Now, to give a small background of the previous, now really this we had IAS 22 and this has moved to IFRS 3 and then this has moved to IFRS 3 revised, the updated version. Now we have this. Now at the time of IAS 22, they calculated something called partial goodwill. Now you see, A, invest in one, B. Okay. Now let's say A invest. Now the share capital of B, let's say 1 million. Number of shares, 1 million number of shares. They are purchasing 650,000 shares. A is purchasing 650,000 shares, and the par value of a share is $1. So how much then? Share capital also 1 million. Whereas A paying $800,000. A paid $800,000 in acquiring 650,000 shares from company B. So actual cost of the investment is how much? 1 million into 65%. Correct? That's supposed to be the cost of the investment. Whereas they paid how much? 850. The amount of share capital that they are receiving is 650. But the money that they are paying, 850. We call it purchase consideration. Purchase consideration in securing the investment or in securing this equity is 850 and they are receiving only 650. So the difference of this 850 and 650 is 200. Why they had to pay this 200? They are willing to pay for the extra value the company has. That extra value, nothing but goodwill. Understood? All of you understood? So, now, previously what they have done actually, they have taken this, now this one we name it as what? Purchase consideration. We name this as purchase consideration, and you see purchase consideration $850 minus, we call it net assets acquired. Why I am using the term net asset here? If you remember from your Musa's regime, very old days, we learned asset is equal to equity plus liability, and accordingly asset minus liability is equal to equity, and this answer is what? Net assets. And I am acquiring share capital, equity, meaning I am acquiring the net assets. Okay, so how much I am acquiring? 1 million into 65%, which is 650,000. So answer is this is old method. Please remember, this is old method, and this goodwill be now we naming it as partial goodwill. We name this as partial goodwill. Now the IFRS 3 went out to revise, and now they said that at the time of acquisition, now you see company B has many shareholders, correct? They have shareholders. And before company A acquiring company B, already there are existing shareholders, correct? Now then they now purchasing 650,000 shares, meaning 65% of the shares. So that means there is existing other left out shareholders. What percentage? 35%, correct? So these 35% shareholders are silently waiting, whereas the company is now selling 65% of the shares to company. And then now they are negotiating. Now at the time of this negotiation, shouldn't any part of the benefits shouldn't be distributed or shared to these people? What do you think? Now see, I am also calling myself an owner of this company. And you suddenly come and take some of the shares and sell it to someone else who is coming to control the business. And I'm already enjoying certain rights and benefits in the company. When parent company is coming and acquiring this, you are compromised. Yes or no? Meaning, when I say you, I'm talking about the 35%. They are compromised. In order to compensate the compromise, we need to look after these shareholders. How do we name them? We name them non-controlling interest shareholders. So now IFRS 3 says the calculation of goodwill should not be like this. Calculation of goodwill should be how? Now you see, I have 1 million shares. This 1 million shares, 60 now into $1 now, because one share par value is $1. So total share capital is 1 million and 65% taken by parent. So they are taking 650,000. 35% taken by whom? This NCI shareholders, that is 350,000. This also dollars, this also dollars. Now at this point, I would like to add one additional statement. IFRS 3 goes on to define how you treating this, how you work, how you arriving a value for this. I will discuss this little later after giving you the basic methodology. So the new new way of calculating goodwill, what happens now? We take the purchase consideration. We take the purchase consideration. How much is the purchase consideration now? In the same example, 850. Correct? And then we have to add NCI share. I will put an asterisk here because the new rules are there in arriving the value, which I will discuss little later. Now I will simply take what is the NCI share? How much? 350. So I will take the total of these two. This is how much? 1.2. Am I right? Correct, no?
Yes.
Yes. Minus
650.
fair value of identifiable net assets at the date of. This is all very important. It has all different important meaning. This is one important meaning. This has another important meaning. This has another important meaning, and this also has important meaning. I will discuss all of them. The fair value is important, identifiable net asset important, and the date of acquisition also important. So now what now? In this example, I have only now. I told you net asset is equal to what? Equity. What is my equity at this situation? 1 million. So now this we call it. What is the answer? But now you're going to ask me a question. This is isn't it the same? I also have 200,000 here. I also have 200,000 here. What the main difference? Now difference is going to come when we talk about these different methods. Now we need to give justice to the non-controlling interest shareholders in ensuring their benefits are treated in the right way. Now, before I go any more further, I also now like to talk about date of acquisition. Anyway, up to this, all of you understood? Oh, looks like I'm talking Chinese language. Anyone feels like that, let me know. I will change the language to Latin. From Chinese to Latin. Chinese, what is it? Mandarin. China, Chinese.
Yes.
Mandarin. Do you feel like I'm speaking Mandarin or English?
Will be better.
I will speak Mandarin better? Chinese. Yeah. So, date topic. See, this is date of incorporation. This is date of acquisition, meaning the purchase date. And this one, financial statement, year-end date. Example, this is 1 January 2019, this is 1 January 2022, this is 31st December 2022. Now you can see, now this I have a time zone here, and then I have a time zone here. Now this time zone, I have a special name. That time zone we name it as pre-acquisition. And this time zone, what do you think the name I should give? Post-acquisition. Up to the date of acquisition, it's like, you know, the marriage arrangement.
Engagement first, this is the date of acquisition. For marriage. After marriage,
See,
Not complicated. Living together, all these not
no.
complicated.
Listen to my example. In an arranged marriage, up to the date the marriage is taking place, husband and wife living separately, and they have their own financial affairs. Meaning, I have a job, she has a job, so they work. They have their own bank account. So my bank account I manage, her bank account she manages. But from the date of when the marriage takes place, then the bank account, ATM card, passport, everything of husband
Owned by the
will be given to
wife.
whom?
I am afraid to tell my
Yes.
Owned by the wife.
Yes. So this should be given to wife. So to the date of acquisition.
Should be.
I'll call you back. Yeah. So, to the date of acquisition, the parent has their own financial activities, the subsidiary has their own financial. Now, in this marriage arrangement, now we have husband and we have wife. What do you think? Who is parent and who is subsidiary?
Wife.
Wife is the
Wife.
parent and husband is a subsidiary. You know, from Asian countries, the dowry, the concept of dowry, I don't know in Middle East or Philippines, I don't know how it works.
Now they have babies also.
Dowry have written also, the girl has to pay?
No. Before this one.
Where have you been here?
Before this one,
I don't think so. You have no.
I'm not paying the dowry.
You are not paying means you are still not paying. Oh, you didn't pay though.
No, I don't think you have the. Did you pay something to your husband? No.
No.
You don't have the.
Only India,
Yes.
Singapore.
Sri Lanka, India. See, what happens is, if you need to, the girl acquiring husband. So, husband is a subsidiary, girl is the parent. In acquiring the husband, the girl has to pay goodwill. Understand me? That's exactly the concept. Is that now that's the date of acquisition is important. After that post acquisition date, even the parent of the husband cannot walk into the house with the slippers. This will be the terms and conditions. So we talked about control, financing and operating, policy decision making. Who will have the control now? Now we also told about that remote control now. If you want to change anything, change before you get married. Because after marriage, even you can't change the channel, TV channel.
Bring up agreement.
So, up to the date of
Muslims, right? It's different.
Yes.
Muslims, man has to pay for the lady.
Yes. So that's a different now. Religious wise, a different story. Then the man need to pay mahar. Mahar. That's different. I just talked about the general practice. Okay. Now, any any reserves or any coming back to that bank account. Now the husband's bank account money and the wife's bank account money kept in two separate pots. So we have two separate pots. Funds are here, funds are here. So at the date of acquisition, what happens? All the funds of the subsidiary will be controlled by parent. So that's why in calculating the goodwill, in deciding how much is the dowry, you got to see this fellow is a doctor or engineer or what is his background, he has a vehicle, he has a personal business, all this comes in. So in deciding goodwill of the subsidiary, the parent will assess what is the net asset worth at the date of acquisition. Until the date of acquisition, whatever the pre-activities you will put together in calculating goodwill. By then, kalas, masalama. You have taken it, then post-acquisition, any financial results, it is not belong to whom? The subsidiary. It is belong to the parent, provided the subsidiary has non-controlling interest, a portion will be shared. You know, the poor parents of the husband need to pay monthly 1,000 riyal, and then you, how many approval you need to take? So that is again, they are the non-controlling interest scenario. So I want this video to be distributed.
Yeah.
So now please understand, this is the analogy that I am trying to develop in order for you to better understand the concept. So standard says this: up to the date of acquisition, all the reserves the subsidiary has should be factored in calculating the goodwill. So now I hope you understood this diagram now, right? So with this I will continue in the next session. Thank you so much.
Next session should be give us a plan for full control for the